There are a number of metrics used to analyze stock investments, and, like all things in life, the value and effectiveness of them is often fiercely debated. In this video, I'm going to look at a stock's dividend yield and yield on cost. I'll briefly define what both of these terms mean, before offering a detailed view into the pros and cons of each measurement. I've always been a big advocate of yield on cost, but whilst researching this topic, I came across a really interesting counter viewpoint, which I'll share later on in the video. It certainly opened up my eyes and is a theory that I hadn't seen anyone else mention before. So, first of all, very quickly, what is a dividend yield? The dividend yield of a stock is the current dividend amount divided by the current share price, expressed as a percentage. So, if we have a stock worth $20 that pays a $1 dividend, we divide 1 by 20 and get a 5% yield. So then, what is a dividend yield on cost? The dividend yield on cost of a stock is the current dividend amount divided by the price initially paid for that share, and is again expressed as a percentage. For example, if we purchased a stock 5 years ago for $20, and its current dividend is $2 per share, then the yield on cost for that stock would be 10%. So why is yield on cost important? If a company increases its dividend after you purchase shares, you'll enjoy a higher rate of income return on your original investment, i.e. your yield on cost rises. Dividend investors like myself like tracking the yield on cost of their holdings to see the power of consistent dividend growth. I find it exciting to see an investment literally begin to pay for itself with higher dividend income over time. For example, imagine buying shares for $20 that, thanks to dividend growth over the long term, now pays a dividend of $20 per share. This is a dream scenario for me. Building a juicy yield on cost can also really help with the compounding effects of reinvesting those dividends. Again, for example, imagine you've invested $100,000 that had a 3% yield at the time of buying. This would mean that you would receive $3,000 a year in dividends. Now imagine that, over time, through consistent dividend increases, you now have a yield on cost of 15%, and therefore would be earning $15,000 a year in dividends. Naturally, an increase in cash flow means an increase in purchasing power. So you're able to purchase more shares that pay more dividends, and so the snowball effect starts to take hold. There's a famous real-life example of how yield on cost can provide incredible returns in the future. From 1988 through to the early 1990s, Warren Buffett spent $1.3 billion scooping up shares of America's most renowned soft drink company, Coca-Cola. According to the last Berkshire Hathaway shareholder letter, he bought around 400 million shares at a cost basis of $3.25. As we flash forward to today, Coca-Cola pays a dividend of $1.68, which gives Buffett a 51% yield on cost. Quite incredible. This means that every year, Buffett receives around $672 million in dividends from Coca-Cola. When you remember that he paid $1.3 billion to acquire the shares, you can see he's receiving half of his initial investment back every year through these dividends. And to put it another way, every 2 years he's receiving his initial investment back in full. It's a great example to see how the passage of time and business growth make the initial amount of money that you set aside to invest in a stock work harder and harder on your behalf. And I'm realistic enough to know that these kind of numbers will be way out of my reach, but it's inspiring to think how a scaled down version of this might look in my portfolio. To look at another real-world scenario, when investors look at current dividend yields, they may view certain levels as being too small an amount to be worth investing in. For example, I love Apple stock, but often hear of people claiming that a current dividend yield of under 1% isn't worth it, as it won't generate any significant returns in terms of dividend cash flow. After all, we'd only be getting less than $1 back for every $100 invested. I think this is very short-term thinking, and as a long-term dividend investor, I view things very differently. If we look at the yearly dividend history of Apple, They first started paying dividends in 1987. These were very small amounts and started at a quarterly dividend of 6 cents and ended at 12 cents in 1995. Then we had a spell where Apple actually stopped paying dividends before restarting again in 2013. In fact, since 2013, dividends have nearly doubled from 42 cents to 81 cents in 2020. The average dividend increase since dividends were reinstated is 10% per year. We do need to remember that past performance isn't always indicative of future results, but if Apple were to carry on this rate of dividend increase, we could build an attractive yield on cost. This graph shows what the dividend payment could become if it carries on growing at 10% per year. So we can see it could develop into quite a nice amount. And now looking at this graph, assuming we bought one share right now for $143, we can see what our yield on cost could become in the future. Again, I just want to reiterate that past performance isn't a guarantee of future performance, but this is a strategy that I employ for my investments, and I'm always looking to target companies with a growing dividend to build a nice future yield on cost. So, what about the case against using yield on cost that I mentioned earlier? I like to be balanced on this channel, and the case against yield on cost mainly involves something called opportunity cost. Opportunity cost is the value of the next best alternative when a decision is made. In simple terms, it's what you could have made. So, let's say you initially bought $20,000 worth of shares at $50 each, which would get us 400 shares. Let's also say that this stock paid a $1 dividend, so the original yield was 2%, and you'll be paid $400 a year in dividends. Let's fast forward a few years and imagine that the company now pays a $5 dividend. Your yield on cost is 10%, and you are now being paid $2,000 a year in dividends. But what if the price of the shares has risen to $100 each as well? Your initial investment of $20,000 now has a market value of $40,000 if you were to sell. So, if you sold all of your shares and bought other shares with a current yield of 6%, which is lower than your 10% yield on cost, you'd earn $2,400 from the new purchase, which is a higher monetary value than your $2,000 a year from your initial investment. This is something I'd never considered before, and the theory does make a lot of sense. However, as much as I understand the counter-argument, for me, the risk of selling to put my capital into another company is something that I'd be uneasy with. I think if you've had conviction into investing in a company, selling all of your shares to invest in another company just because of the dividend yield doesn't sit well with me. What if the new company's dividends aren't as stable as the original company? What if the fundamentals of the company are different? I understand that you could argue that the money could just be reallocated into another stock that you own, and therefore also have conviction on. But then, surely, you just end up with all of your cash invested into whichever company has the highest dividend yield in your portfolio. And chasing high dividend yields just isn't a sensible strategy in my eyes. Whilst I do appreciate the theory, and it does make a lot of sense, for me, I'm happy to continue measuring my investments using a yield on cost approach. And I feel this is very relevant for me and my goals, as I look to build a portfolio that can deliver sustainable and growing cash flow long into the future. I hope you found this video useful and informative. If you have, then please like the video and subscribe to the channel. I'd also be really interested to hear your thoughts on the video in the comments section below. Thanks again for watching, and I'll see you on the next video.